Pin bars are another useful individual candlestick pattern that we can actually find in the market to catch reversal points. Now, that's what pin bars are for. They are basically a large candle. Let me show you an example of one with a very big wick and a very small candle body. However, what's different to the indecision candles of the dojis and spinning tops is that with the pin bar, we have a very big wick one side and a very small wick the other. So this big wick candle there with the little red candle body is a pin bar, and that is a bearish pin bar. Now, what this shows that's different to the indecision candle is that the pressure one way is very much stronger than the pressure the other way. Now, when we see a doji, we pretty much have these equal wicks either side. Now, for example, this doji candle here, it doesn't really give us much indication of what could be happening. However, when we see a big pin bar like this with a very small wick one side and a very, very large wick the other, that shows us that, okay, the selling pressure here is massively strong, more so than the buying pressure on the other side of the candle. So a pin bar can therefore be used as essentially a trigger point for certain trades. Now, they should never just be used on their own. If you just see a random pin bar with little to no actual use, then it's not going to be too important. It's not going to be too valuable. However, when we see pin bars at the tops of rollover movements or at the bottom of these pickup movements, for example, in the peaks and in these little troughs as well, when we see the pin bars in these areas, they can be actually quite useful as trigger points. Now, it's more so what they present. So if we look at this pin bar, then we can see basically we have supply zone over here. We're in a downtrend, right? Lower lows, lower highs. We've seen the supply zone, and what we've actually seen then is the market push up. And the market has pushed up and started losing its momentum here. Now, this would be the point at where many would sell. So because we understand the idea of supply and demand, we know that these zones are going to be retested. It comes back to the imbalances that we've spoken about. So hopefully, having used what you've learned so far, you should have the knowledge to actually avoid selling until we trade into a zone. Okay, so we don't want to sell this because we haven't actually tapped into that zone. But what we actually then see is this big pin bar candle. And when we see the price trade into that zone and then push back down, that shows us that there's a lot of selling pressure there. Okay, we tried to go higher, right into the supply zone, and then the market pushed it all the way back down. And it ended up closing under that previous candle. So this shows us that, yep, there was selling pressure here. However, we did need to go and fulfill that final area before the market could go down. Now, this is where the real liquidity sits. This is where the real institutional orders are going to be waiting. So in this instance, we'd use the imbalance to avoid taking a bad trade. And when we saw the amount of selling pressure that this pin bar presented in the market, this is where we could actually then look to short the market. And as you see, we have a selling opportunity that goes very, very far down. This would have been your trigger point for the trade. And if you were trading a pin bar, you should always keep your stop loss above the pin bar, because another thing to mention is the pin bar often forms a final high or low in the market, because what it is a final run to fill liquidity, a final attempt at much higher or drastically lower prices. So here's a nice pin bar example then. In line with, of course, other confluences, as mentioned, we never want to trade a lonely pin bar with nothing else around it. But if we were to see, for example, this supply zone tapped into, massive selling pressure brought in, closes down here, pin bar candle, we could then actually sell that market off, continue that downtrend. And as you'd have seen, we could have caught some pretty exciting profits by using that pin bar. The important thing to note, which is what I just said, where it forms a drastic high or low in the market, is after we form this pin bar, in line with the other confluences and in line with the trend, price never got that high again. So we even have a secondary pin bar opportunity here, okay? And basically, what we see is two equal highs in the market, 1, 2. We know we're in a downtrend now. We've fulfilled this liquidity. We formed 1, 2 equal highs. The market then begins to roll over. And what this pin bar does is go and take that liquidity, okay? That's what pin bars are good at doing, just filling the final bit of liquidity. For example, this one here, the market did have selling pressure to roll over, but we know the institutional orders are in supply zones and demand zones. So when a supply zone is tapped into and we see a huge pin bar like this come out of it, well, that shows us that all of the selling pressure that's in this zone has now been fulfilled and the market is ready to go down. So that's much like this opportunity that we get again here. Okay, we know the selling pressures in the market now. We know we're in a downtrend. We see 1 rollover, 2 rollover, and it looks as though we could be ready to go. And when we see the pin bar take the liquidity and then we see the selling pressure enter and push it all the way back down again to close down here, well, then that is going to provide us with another selling opportunity. Okay. So never use pin bars alone, but if you can use pin bars in line with the other market confluences, identifying the areas where pin bars have gone for liquidity, because that is what they do, that's what they're for, that's what they show, then that is going to provide you with a good opportunity to either buy or sell in line with the trend. So a nice example here, if we look at this one, big downside moves, then we come and form this bottom, okay? Form a bottom in the market there, support, come back up, wick through to fill liquidity, the buying pressure is pushed all the way back up and we actually close above these previous candles, well, then this could provide us with a buying opportunity, okay? Now, stop loss beneath the pin bar, of course, as we've said. And you could have actually looked to take this, back into the supply zone above, right? That supply zone in here. So to fill the price imbalance into the zone before the next opportunity to sell, okay? You can see how things are coming together. Now, what you'll notice on this movement is we did get another push down, but the push down never took out that significant low point that the pin bar formed, because this pin bar is that run for liquidity. So the pin bar goes as low as it can to fulfill those buy orders of the larger institutional players. And that is what pushes the candle back so sharp, because retail traders do not have the strength and do not have the money in the market to push a market, snap a market back this fast. So this is likely the work of banks and institutions, where the market just takes a run to fulfill their orders and then bam, it starts flying. So we form that significant low in there, and then we never actually go that low again until the next zone is met. So that's a nice additional way to use a pin bar, showing, of course, the selling examples and the buying examples. So a pin bar then, in a nutshell, is going to be a decisive candle that shows a push in one direction or the other. And it's always going to make a run for liquidity. Now, that is what they're for. We find a bottom in the market 9 times out of 10, and then a pin bar will push past that bottom in the market. Or on the flip side, we find a top in the market like this one, and then the pin bar is going to push past that top in the market to fulfill a zone, fulfill liquidity. Now, as you can see, even this one here is a supply zone tap, okay, to fulfill liquidity. And then the big push down shows that liquidity has been filled and shows that the selling pressure or the buying pressure has really been forced into the market now. So there we go. That is pin bars in a nutshell. Now, as mentioned, they do have big wicks like dojis, like spinning tops. However, these ones are much more decisive because they show normally around or after a bottom has been formed, they show a big wick on one side and a small wick on the other, which shows a big push in the market from that one direction. So here we are again, just a final example to talk through. We have, of course, a bottom is being found in the market. Okay. Basically off of this previous low point, 1 wick, 2 wick, all of these candle bodies forming this bottom, but then we have one final push down to fulfill the liquidity to trade into the previous structure, high point, structure, low point, to fulfill that higher low kind of formation before the market really takes off. So we are looking for these as final pushes of strong buying or selling pressure in a given direction to actually hop onto and enter a trade in the right direction. Now, when it comes to positioning your stop loss, you always want to keep it further than the pin bar, and you always want to make sure that when you're using pin bars and trading pin bars, that you're trading them logically, and you're not just trading any old candle, okay? So let me just find a couple of examples of random pin bars within the price action that are kind of going to be meaningless, because I'm sure we're going to find a few. So, I mean, we've got some here. Okay, we have some pushing down here, but we don't really have anything traded into yet. Now, if you look at this supply zone, we never really traded into that. Okay, we just got these pin bars pushing down. Now, this is why you need to be careful with what you're trading, because you might see, right, we are now ready to turn over because we're seeing a buildup of pin bars, bearish pin bars. Okay, but as you'll see, these bearish pin bars soon turn into bullish pin bars, and then the market continued in that direction. And that's because the bullish pin bars went in line with the trend direction. Okay, high taken out, retest and continue higher, and the zone wasn't even met with any of these pin bars. So you really want to focus on zones and structure high and low points when you're actually using these. Don't just sell because you see a pin bar, or don't just buy because you see a pin bar. But if you see a pin bar in line with other market confluences, etc., the trend direction or supply and demand zones, things like this, then that is where you're really going to find the viable and valid pin bars to actually trade from. So hopefully that has been useful. Now go into the markets yourself, use the past price data, as I have been in all of these videos, and just have a go at finding the overall flow of pin bars in the market. Okay, I want you to find some pin bars at the tops and bottoms of trends. Find ones that have been successful in identifying reversal, and then find ones mid-trend and in messy areas, and ones that have been unsuccessful, because you need to see examples of where they work and where they don't. And doing that for yourself, getting that real market experience for yourself, is going to be really, really valuable in finding how to actually use pin bars for yourself, when they're going to be useful, when they're going to be valid, and when they're not. So I'll see you over in the next video. We are going to actually talk about my favorite entry signal in the next video, and that's engulfing. This is the one I use more than anything else. So make sure you do your homework, and I will see you there.